Welcome back, everyone. Thanks for joining. In today's episode, we're going to be going over my simple game plan of what I intend on doing with my investments if the United States enters into a war with Iran. We've heard talk from many officials, including the president, that we might help out Israel in bombing Iran to prevent their nuclear program. Now, there's a lot of discussion on this topic, a lot of debate. We don't even know if we're going to do it. In fact, Trump himself says that nobody knows what he's going to do.
I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do. I can tell you this, that...
So we don't know anything for certain, but over the past couple of days, it has become clear that the United States is getting closer to a direct conflict with Iran. It is a real possibility, and it does have major implications, not just geopolitically and across the world, but with investments, with our portfolios. These type of events are often a time of stress, where investors make really tough decisions. And that's why I'm going to lay out very clearly, very simply, exactly what my game plan is with my investments. I'm managing over $1 million in my portfolio, and I'll be clearly showing you exactly what I'll do in these different situations and different possible outcomes. Whether or not the US enters into this war or whether things continue on, I'll be showing you my game plan either way. Now, as always, we have a ton of news to get to in this episode. For example, Andy Jassy, the Amazon CEO, he sent out a memo basically saying that artificial intelligence is going to make it so that they need fewer corporate workers. We'll be going over this memo, my take on it, what I think this means for Amazon. We also have a lot of Robotaxi news today. Amazon's Zoox, that's those little carriage Robotaxis that Amazon's creating, apparently is boosting their Robotaxi production ahead of their launch in Vegas. So we have another entrance into this race. We have Waymo gradually expanding its territory. Now, the headline here uses the word gradually, but this is a rather large expansion. We're going to be looking at the exact maps and what Wells Fargo analysts are saying that Waymo can be in 5 to 10 years. We also have some OpenAI news. OpenAI and Microsoft are apparently having a little bit of a heated debate amongst these two companies. They started firmly as partners, helping each other out, but now they've moved into the category of partners and competitors. We'll be looking at this debate between OpenAI and Microsoft. We have a viral clip of Sam Altman here on a podcast. OpenAI is getting their employees poached, or at least they're trying to, by Meta. And the price tag that Meta is willing to pay for many OpenAI employees is $100 million. That's just a signing bonus. That's not their salary. A massive sum of money, more than what NBA players are making. And Sam Altman proceeds to trash talk Mark Zuckerberg and Meta, saying that his company is bigger, it's better, it's going to be worth more, the employees are more excited, and so on. We'll be going over this news and if there's any truth to it. So as always, we have a ton to get to in this episode, and we start off with the main story, which is the United States' potential direct involvement with Iran. We know that the United States has been allies with Israel for a long time. We supported each other, shared intelligence, shared military technology, and so on and so forth. But up until now, we have not had a direct strike from the United States into Iran. This is a potentially new involvement. And this is why it's creating so much uncertainty and speculation. We have news articles like this, more and more every day, from the BBC just an hour ago, noting that the United States is moving 30 jets as Iran attack speculation grows. So we're quite literally, not just figuratively, getting closer to Iran. Military forces are mobilizing around Iran. And this is based on the failure of Iran to negotiate a deal with President Trump on how to deal with nuclear technology. Now, it's not just the physical military positioning and posturing that's causing the speculation. We also have direct commentary from President Trump about the potential, or at least the chance, of the United States directly striking Iran. I want to play a clip from an interview with Trump just hours ago where the president was asked about the potential of the United States striking Iran. Quite directly, he was asked this question. Here's his response that's rather ambiguous.
I don't seriously think I'm going to answer that question. Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do. I can tell you this, that Iran's got a lot of trouble, and they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine.
Now, Trump makes it clear that he doesn't want to give advanced warning of a potential military operation. Obviously, that makes sense, but it leaves us in this state of uncertainty, not knowing exactly what's going to happen. What we do know is that The United States is at least weighing these options heavily. And there are people in the Republican camp that are much in favor of striking Iran, a lot of them. There's people in the Republican camp that are far against it. And there's this internal dialogue and these people going back and forth with each other debating this. Trump is weighing the political implications, the downstream implications, and the direct implications of leaving Iran to continue developing nuclear technology. So all of these considerations are going on. Right now, we don't have a clear answer of what the US will do. We know that if the United States does attack Iran, they'll likely use what's called a bunker buster. The Wall Street Journal has an article going over these devices. There's only like 20 or 30 of them in the world made. They're called massive ordnance penetrators, and they're unique in that these are one of the only bombs in existence. In fact, outside of a nuclear bomb, these are the only bombs that can plummet through 200 feet of mountain rock before exploding. These are dropped at such a height, they weigh so much that they can burrow through 200 feet of mountain before being detonated. And these are the bombs that would likely be used if we attack Iran. This type of technology being used directly on Iran would put the United States in a different situation than it is now. Right now, it's simply aiding Israel, and that's the relationship. This changes the relationship. It changes the dynamic between Iran and the US. This would be a major escalation and could cause greater uncertainty. So this is what investors are weighing. Now, I'm not in a position to tell you what the US should or shouldn't do, what is the right decision here, or how it will ultimately turn out, but I am an investor. And when situations like this happen, I think it's important to know in advance what your strategy is going to be. Between the passive income portfolio and the story fund, I'm managing over $1 million. This is my own money that I've invested and built up. We have a combined over $500,000 in gains. Now, looking at this, I want to go over step one of my plan. The first goal that I have in this plan is to not sell a single share of a company. Even if this situation escalates, if the market drops, if things go worse, if things look bad, even if it looks like we're on the verge of World War III and everybody's talking about how bad it's going to be, if investors become scared, if sentiment goes south, if we have the same type of situation we had in 2021 or in 2020, where we had COVID and everybody saying how the end of the world was happening, even if it becomes that dire of a situation, my goal is to not sell a single stock. Not a single share, not even trim one position. And the reason for that is simple. During time periods where you have major conflicts or macroeconomic events, whether it's COVID or new wars, that's a time period where investors make emotional decisions. They're not well-informed decisions. Most investors sell at the wrong times. Investors would do better had they just held on to their companies. It is extremely difficult to sell on the high and buy back on the low. Most investors are not going to pull that off. And your emotions may get the better of you. Once you start hearing about how bad things are, how this is going to escalate and escalate, it becomes far more tempting to hit the sell button, to just trim a little bit, to just lighten up in anticipation of how bad it's going to be. And although that seems logical, every bit of data shows that most investors would be better off if they just held their shares. Another reason that I believe it's better to not sell is simply because of the composition of my portfolio. We have a new update in Qualtrim on the portfolio page that illustrates this quite well. This is my combined portfolio between the passive income portfolio and the story fund. So all the stocks that I own and the weighting and the gain and loss in them. This is just my current holdings. Now, when I look at this, I have Netflix as my top position, mostly because of the amount of gains in this one. We have it as an 11.6% position. Then we have S&P Global, Amazon, MasterCard, Microsoft, Texas Roadhouse, Costco, and so on and so forth, all the way down the list. What you'll notice with these companies, which the AI analysis points out, is that this is weighted towards distinctly high-quality, dominant businesses across technology, financial services, and select consumer sectors. These are dominant companies. They're not ones that I need to sell, even if we go through troubling times. If you as an investor need to sell your companies because times get difficult, I believe that that means you've picked weak companies, too weak of companies. If you're concerned that a war is going to disrupt your company, that it's not going to be able to thrive because we've entered into a new war, that's a company that's not worth holding. The type of enterprises that I own are compounding machines. These are companies that make substantial amounts of wealth. They enrich investors. They increase your buying power. They can survive in any type of economic environment, whether it's low interest rates, high interest rates, whether we're going through a recession or an economic boom, whether we're going through times of a COVID pandemic or a new war, these companies will survive. And not only will they survive, they'll make me rich in the process. They'll increase my buying power. These are companies that are incredibly profitable and have incredibly resilient business models. So the goal of not selling a single share, even if things become scary, is much easier to accomplish if you hold great companies. If you hold weak companies that you don't know how they're going to do, that they have weaker business models, these are ones that are a mistake to own, and they're going to be very difficult to hold on to if we get into a major conflict and things become scary, if sentiment turns south, which it can. So the first thing is to not sell a single share. The second thing I plan on doing is positioning myself to be able to buy this dip. The best tool I use for this is the dip finder. It's one that I created. That's why I like using it so much. But I think it's the best thing to highlight how your companies are trading. For example, this is a quick look at my entire portfolio and how it's moving today. We see that MasterCard is down big today. Same with Visa. It's because of the stablecoin bill being passed. But regardless, I can see at a glance how my companies are doing. S&P Global, ASML, Moody's, Netflix are moving up a little bit. These companies off to the left are trading down. I can go back to the past 5 days. I can go back to the past 1 month. Whenever there's some big macroeconomic shock going on, what I'll do is I'll pull up this chart and simply just look at which companies are dropping the most and position my portfolio to buy those dips. In this case, I'll look at which companies are going down 10% or 20%. And every threshold, I'll deploy more money. Right now, I'm in the process of transferring $10,000 into my brokerage account. This is anticipation for a potential dip if we enter into conflict. It's no guarantee I'll buy a company if it dips, but if it does dip and it's one that I'm already looking at buying, I will deploy extra money during a dip. I've done it many times. I think it's one of the best ways an investor can dollar cost average into a company. Wait for any type of macroeconomic event like the tariffs, like COVID, things that really scare investors. Once investors are spooked, the prices go down. You use these tools to look at how much they've fallen, to analyze which ones are at the best deal and target those companies. One company that I may buy more of, especially if it drops down more, is Equifax. This is one that I've been building my position recently. Equifax is a relatively small holding in my portfolio. In fact, I believe it's one of the smallest here at $33,000, only $3,000 in gains. And this is again one that I'd love to double the position size. I'd love this as a $60,000 position. So if it gets pressured downwards at all, I'll be looking at that opportunistically. Now that is the game plan, those 2 steps. First, not sell a single share, and second, position myself to buy dips incrementally as stock prices drop out of fair. Those are the 2 steps, simply put. You may have thought that it was going to be more complicated, that I'd have to have some super complex game plan, but that's not how investing works. Simple good decisions override complex poor decisions. The real challenge for investors is both having good judgment in the companies they buy, their initial investments, making sure you own high quality assets, but then secondly, and I'd say even more importantly, is your temperament. Your ability to withhold from making emotional decisions, from selling when things get scary, and knowing what you're going to do before it happens. So even though this plan is simple, it is difficult. Implementing it is easier said than done. You might scoff at it and say that, yeah, I can hold on to every share and buy the dip. But when things really start dipping, even good investors that otherwise would say that I'm going to buy every dip in the future, as soon as the tariffs happened, real good investors started to get scared. Some of them sold towards the bottom. We saw it in a lot of the data. A lot of retail investors sold, a lot of hedge funds sold. I bought the dip during that time period. I'm serious in saying this is my plan, and it's exactly what I'm going to do. So there you have my personal game plan on this, which I biasly believe is the best one. Now let's go ahead and get to some news. Now first we get to this news story where Amazon CEO Andy Jassy released this publicly, but it was an open letter to the employees of Amazon going over his thoughts on generative AI, and in particular, that he's going to need fewer corporate employees. Now, recently, in fact, in the most recent episode, I went over Amazon as a robotics play, an AI play. I think it's the best AI play, quite literally. I think it's the best position company to have massive operating leverage. But my thoughts were more directed towards the logistics side. See, I think that Amazon has an opportunity to create robots, to house them in the vans that go around to your neighborhood. Those robots can jump out and deliver packages from the van to your doorstep. Now, Amazon does that millions of times a day. They have millions of customers. In some cases, they're dropping off packages twice a day. That last mile delivery is super expensive. They have 400,000 employees doing that. So if they can get the robots smart enough using artificial intelligence, it made sense that they could perhaps make things more efficient, make it more profitable, raise the margins of a very low margin business. But Andy Jassy here is focused on something different: his corporate employees. Now, before jumping into his commentary on efficiency gains, he speaks more broadly about generative AI, saying, "Today in virtually every corner of the company, we're using generative AI to make customers' lives better and easier." What started as deep conviction that every customer experience would be reinvented using AI and that altogether new experiences were only dreamed of would become possible is rapidly becoming reality. This is true and something that I've tried to highlight. Artificial intelligence can benefit a company in two broad ways. One, if you're creating it and selling it, like OpenAI or Google. And then two, if not only are you creating it, but if you're just using it and you have a lot of applications for it. The more applications you have to use AI, the better off the company is. In the case of Amazon, I cannot think of a company that has more potential applications of artificial intelligence. Can you? Just a couple specific examples I've seen that are very good examples of AI benefiting Amazon is the reviews. When you go into Amazon now, you get a summary of the reviews. It's like a breakdown of it, of all the good and bad, instead of having to read through them individually by yourselves. This has saved me enormous times when shopping. I can confidently just look at the summarized reviews from everybody that leaves a review and see what's good and bad about the product. Another thing is when buying shoes on Amazon, it was hard to size them, but now Amazon has predictive sizing of shoes. Based on millions of orders, they will tell you which shoe will fit your feet. And this is nice because it normalizes differently sized shoes across different brands. These are things that artificial intelligence are dramatically improving with Amazon that's going to continue happening. We're going to see literally thousands of these type of improvements across this company. So Andy Jassy is being truthful here, saying that Amazon is being reinvented by generative AI. He says technologies like generative AI are rare, they come about once in a lifetime, and completely change what's possible for customers and businesses. So we are investing quite expansively, and the progress we are making is evident. You can see it in what we're rolling out with Alexa Plus, our next generation Alexa personal assistant that's meaningfully smarter, more capable, and is a first-person assistant that can take significant actions for a customer on top of providing intelligent answers on virtually any question. So they're actually doing what Apple's struggling to do, which is to make their voice assistant use AI and use it really well. They say that you can see that our AI shopping assistant that's being used by tens of millions of customers around the world to discover new products and make more informed purchase decisions. You can see an increase in the array of shopping features like a lens. Very cool to be able to take a picture of an item and have it pull up the shopping result. I've used that exact thing as well. It works better than you'd expected. The Buy For Me, where I can ask shopping agents to buy an item on another merchant's website for me, and recommended size. This is the thing I was talking about, where it can predict your exact shoe size, where we can predict the right size for you based on prior purchases and how different apparel brands run fit-wise related to each other. So they've taken all these different sizings from different brands and normalized it. That is an incredible technological challenge that only AI could solve. And that's massive for a company trying to sell clothing online, which by far the biggest challenge is making it fit. He goes on highlighting how they're helping product sellers, third-party sellers on Amazon, create new product detail pages, get advice on how to be even more efficient as a seller, and so on and so forth. He goes over all the different technologies in AWS. Obviously, they're wrapping AI into everything they're doing. They're also creating training chips to be able to better serve AI. So Amazon's on both sides of the coin here. They're both creating AI, helping other people use AI technologies, and they're of course the backbone of many companies growing their AI business as well. We're also using generative AI broadly across our internal operations. In our fulfillment and networks, we're using AI to improve inventory placement, demand forecasting, and the efficiency of our robots, all of which have improved cost to serve and delivery speeds. We've rebuilt our customer service chatbots in Gen AI, providing an even better experience than what we've had before. And we're assembling a more intelligent and compelling product detail pages leveraging generative AI. When looking at the business, there's areas of category that Amazon is intent on focusing even more on. They have strong conviction that AI agents will change how we all work and live. Think of agents as software systems that use AI to perform tasks on behalf of users and other systems. They say second, what makes the agentic future so compelling for Amazon is that these agents are going to change the scope and speed at which we can innovate for our customers. Agents will allow us to start almost everything from a more advanced starting point. We'll focus less on the rote work and more on the thinking strategically about how to improve customer experiences and invent new ones. Agents will be teammates that we can call on at various stages of our work, and that will get wiser and more helpful with more experience. If we build and leverage the right agents, it's going to rapidly accelerate our ability to make customers' lives easier and better every day. So he's advertising this as always being better for the customer, very exciting changes for the workers as well. And third, we're going to keep pushing to operate like the world's largest startup, customer obsessed, inventive, fast moving, lean, scrappy, and full of missionaries trying to build something better for customers and businesses that outlast us all. Now, that's a lot of lead up, a lot of build up to the most important paragraph here, the biggest takeaway for investors, where he says that as we roll out more generative AI and agents, it should change the way our work is done. We will need fewer people doing some of the jobs that are being done today, and more people doing other types of jobs. It's hard to know exactly where this nets out over time, but in the next few years, we expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company. So at first it looks like this is a thing where they might shift around workers, take them from certain jobs where there's a lot of redundancy, and instead have AI help out with that. But then we get to that last sentence here. We expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively. He fully expects that their total corporate workforce is going to be reduced. So there we have Andy Jassy directly telling employees that there's going to be fewer employees doing more work because artificial intelligence will do so much of the heavy lifting. And that makes sense in theory. Now, this is a debate of what will ultimately happen, but we can already see this in the numbers. For example, right now, if we look at Amazon's headcount over time, in 2019 into 2021, it went up dramatically, up to 1.6 million. So huge rise in Amazon employees. This is them doubling their fulfillment network, making massive expansions in COVID. But then since then, their hiring has basically stopped. And in fact, it's gone down. The amount of employees they have doing the same thing as their revenue continues to grow has been flat at that 1.556 million mark. Still a lot of employees, but it's been flat for 4 years now. And he's saying that it's going to potentially go down even further. Now, putting aside the overall economic implications and the potential unemployment rate, if we're looking specifically at Amazon, this is bullish for the company. If we look at, for example, right now, the free cash flow yield of Amazon, it's right now only 0.91%. The free cash flow yield's really low because they're doing all these big CapEx investments into AI, so only about a 1% free cash flow yield. But then when you net out the additional employee expense of stock-based compensation, it goes down to 0%. Literally, their entire company makes no money if you factor in the total employee compensation. If we look at this visualized, we can see the effect that employees have on this company. Here is Amazon's, let's move to 10 years here. Here's their free cash flow over time on a trailing basis. We look at the free cash flow next to stock-based comp, and you'll see that these numbers are almost identical, making it so that the stock-based comp dilutes away all the cash flows from investors. You're technically getting that cash, but you're splitting it amongst more investors, and this is the net effect. In the last trailing 12 months, investors made $71 million in free cash flow when you adjust out stock-based comp for a company that revenues around $600 billion. If Amazon is able to reduce their total headcount and grow margins while continuing to grow their top line, you'll see this trend of the stock-based compensation continue to decline over time as the free cash flows eventually grow. The free cash flow margin will be massive at that point. And so this is more news telling you that Amazon has immense operating leverage potential. We're not seeing it right now. We're seeing a gradual decline in workforce, but this is what the future holds. And if you believe that Amazon will continue to grow, that their AI investments will pay off, I believe this is one more bullish catalyst. Now, in terms of the overall economic impact of companies becoming more efficient with artificial intelligence, a lot of people are concerned about overall job loss, the inability of people to find new work, companies just becoming more greedy and shrinking their workforces. And I believe that there's more to the story than that. I've tweeted this out, I've talked about it frequently, but I believe the reason that overall people see more job loss than they see job gains, or they're predicting that, is because we can easily see and comprehend how AI is going to take away certain positions. We already know the positions they're going to impact. We can already see what AI is capable of. What we're not able to easily see and comprehend is the new opportunities AI will create, the new jobs that we don't know will exist that will exist. And Sundar Pichai has eloquently stated this. He said that the biggest AI company in the world probably doesn't even exist right now. Google was started years after the internet was invented. It's one of the biggest companies in the world. So in 2 or 3 years, we may have AI startups become the biggest companies in the world that literally do not exist today. So I am not convinced yet that overall artificial intelligence is going to lead to higher unemployment. I think that in the short term, we'll see companies become more efficient, margins will rise, but in the long term, I see more companies and more opportunity. That's typically what's happened in the past with similar innovations. Now moving on, we get to some robotaxi news. This is always exciting. We're seeing huge developments here in the robotaxi industry, which right now comprises primarily just of Waymo. They're the only game in town of current working robotaxi networks. We have Tesla right on the verge of it. They're doing tests. We're seeing them drive around without drivers in the driver's seat, which is cool to see. And then, of course, we have Amazon, which has been a bit on the back burner. I've mentioned Amazon a bit here with Zoox. So this has always been potential. They're working towards it. But they've kind of been left out of the conversation, and now they're moving up to the forefront. Amazon Zoox is boosting robotaxi production ahead of its first commercial launch in Las Vegas. Now, Zoox, similar to Waymo, uses all the sensors, all the cameras. They have dozens of cameras. They have tons of sensors everywhere. They use LiDAR. They use it all day. So they're not going the Tesla approach of the bare bones, 8 cameras, no sensors. They're not doing that. They're doing more of the tried and true proven approach that Waymo's using. The unique thing about Zoox is that unlike Google so far, where most of the vehicles have been retrofitted with the sensors on top of them using Jaguars, Waymo does have their own vehicles now. They have their own specific builds. But Zoox has this very custom build. They are these symmetrical vehicles. They're a bit like shuttles. This is something that I'd envision you'd see on the roads of Disneyland or something, where the doors slide open. It's a kind of friendly, goofy looking shuttle. They're spacious on the inside. You have 2 seats that face each other, 2 different bench seats. You can pick the music. Each individual seat has personal climate control and so on and so forth. So they are built specific for Zoox, for robotaxi networks. The breaking news here is that Zoox this Wednesday opened a sprawling new manufacturing facility in San Francisco Bay Area, paving the way for more robotaxi production as it plans a commercial rollout of its fleet later this year. The company will use the site in Hayward, California, to increase its robotaxi fleet significantly. The facility is currently producing 1 robotaxi per day, but Zoox said it expects to accelerate production over the coming year. At full scale, it will have the capacity to assemble 10,000 robotaxis a year, with roughly 3 robotaxis being produced per hour. But the bigger reason that this is notable is that this shows they're taking it extremely seriously. This is not just some experiment. It's not some funny, silly thing that Amazon's doing on the sidelines. It's not a project that they see failure in the future. They are doubling and tripling and quadrupling down on the Zoox effort. Amazon clearly sees this as a predictably successful endeavor. They are betting on this heavily. Now, the Zoox CEO highlights something else important here. Quote, "We don't need to crank out a vehicle every minute because we're not selling these things." And that is an important differentiator between Waymo, Zoox, and Tesla. Tesla has multiple applications for their vehicles, but they're primarily being sold. That's the reason that they're producing so many vehicles. You do not need hundreds of thousands of vehicles for robotaxi networks. Look at what Waymo's doing with only a couple thousand. They're doing tens of millions of rides. They're saturating entire cities. They're taking up more demand in Los Angeles than Lyft. And that's just a couple hundred vehicles. So we don't need millions of vehicles to have a very successful robotaxi network. Having thousands of them is enough. The big important thing here is that they work consistently, that they're safe, and that they're highly efficient, that they have a big network, that they have demand all the time. When we look at the numbers in Los Angeles, the robotaxis are around 200 times more effective than an Uber driver. Robotaxi is the future. So Amazon is gearing up to enter this robotaxi race with force later this year. And Waymo's not sitting idly. They're pressing their advantage. Waymo is gradually expanding its borders in California. The company's robotaxis are now operating across 250 square miles of San Francisco and Los Angeles. We can take a look at the maps here. The dark blue area is where Waymo is already operational. So you can see that it's a large area. But then the lighter blue area is where they're expanding to. They're specifically picking the districts of where it can work best, most efficient. But this is quite the expansion. It's not quite double the area. but maybe a 70, 80% increase in total area. Then we have another picture here. Here's another area. We have Palo Alto, Los Altos, the Mountain View. This is where they're already operational, very successful, and they're expanding outward from this area. This is about double the square miles. We have Santa Monica, Culver City, Beverly Hills, West Hollywood. These are the areas that they're already operational in. Now they're moving into Inglewood. They're moving across Echo Park, UCLA, Brentwood, all these neighboring places. Not quite double, but maybe a 50% plus expansion. This doesn't make it so that they just have more rides in those specific areas, but it makes it so they have greater use cases. Now Waymo can be used by people living outside of the dark blue area that are living in the light blue to go across. Waymo's expanding in multiple ways. Not only are they expanding their square miles across the cities and areas they're already in, but they're also moving into brand new areas rapidly. It seems like every week I'm hearing about new cities that they're opening up, that they're doing testing in. The latest one, not even mentioned in this article. It's breaking news, but they're doing far bigger tests in New York City. They want to expand there. They operate the ride-hailing service in California exclusively through the Waymo One app, so it's not partnered with Uber. In Austin and soon Atlanta, the company has opted to partner with Uber by making its vehicles only available through the company's app. They're testing out both business models, seeing which one they want to go with. While this is going on, Waymo's also figuring out the edge cases and difficult use cases of navigating highways, going to airports. This is technology that they so far haven't done, but they are in the process of tackling these challenges. This company is iteratively expanding across the board. And as I see this news expand, I have to become more bullish on Google. It is true that Waymo is a tiny fraction of Google's total revenue, but the potential here is huge. We hear so much talk about how much potential there is in robotaxi networks, and Waymo is expanding rather fast in this category. Now, at the same time, we have analysis of banks finally picking up on this. We have Wells Fargo analysts saying that Google's Waymo is seen capturing 10% of US ride sharing by 2030. They say that consumer adoption is happening quickly in early markets. Waymo's rides in San Francisco and Los Angeles had already reached a significant share of local trips. The analysts now see Waymo market share reaching 3.5% by 2027 and then rising steadily to 10% by 2030. We're having consistent market share gains by Waymo in every market they operate in of rideshare over time. Now, this does raise questions about where Uber fits in with this. We see that Waymo is part partnering with them, part not. If you're an Uber investor, you're just hoping that Waymo will partner with Uber. That's what you're hoping for. Right now, the analysts are stating that they don't believe Waymo is reliant on Uber because they're being so successful in the markets without them, where they're just doing Waymo One, that Uber doesn't have a lot of leverage in this situation. They can't force Waymo to become partners with them, so Waymo seems to have the upper hand here. They say the prospects of Uber and Lyft to serve as key demand partners for AV suppliers have dimmed recently, as Waymo appears to thus far be going it alone. Right now, as a Google and Amazon investor, I believe I have two significant bets in the ride-sharing market. I don't feel the need to have either a Tesla position or an Uber position to have some exposure to the robotaxi play. Now, finally, we get to OpenAI, and in particular, Sam Altman, making a lot of enemies with a lot of people. He's willing to burn bridges, to trash talk. He's very confident in his company, and he has reason to be confident in his company. But Sam Altman is kind of fighting two battles on two fronts here. In fact, maybe three if you include Elon Musk, but that's not the focus of this one. We have OpenAI and Microsoft tensions reaching a boiling point. This was something that's been reported over the past couple of days. This entire dispute is over OpenAI wanting to loosen Microsoft's grip on its AI products and computing resources. OpenAI so far has this partnership with Microsoft, the 49% ownership that Microsoft has. Microsoft has agreements where they have to use their Microsoft products, and basically Microsoft is very involved in what they're doing. OpenAI wants more autonomy. They want to have more competition with the computing resources they're using. They want to be able to outgrow Microsoft and Microsoft's relationship. They say that negotiations have been so difficult that in recent weeks, OpenAI's executives have discussed what they view as the nuclear option, accusing Microsoft of anti-competitive behavior during their partnership, an effort that would involve seeking federal regulatory review of the terms of the contract for potential violations of antitrust law, as well as public campaigns. This is a potential souring of this relationship to a huge degree. This would be it's true to call this the nuclear option, because likely one of the single biggest insecurities that Microsoft has, one of the most vulnerabilities, is being labeled a monopolist, antitrust. Microsoft has a bit of a history with that. They've gone through it once before. It's a very dark period for any large company to be viewed as this monopolistic antitrust law company. My guess right now is they don't take that option. I don't think they do it. They're growing too fast. They have too many things to worry about already. I think that this is just posturing. I think it's a bit of bluffing. I would be a bit shocked if they actually seek regulatory review for Microsoft. Maybe they will, but I think that'd be very aggressive. It might backfire on OpenAI. At the same time, Sam Altman went on to an interview with his brother. This happened just a day ago, and he trash talked Meta. He said that Meta is now offering OpenAI staff $100 million signing bonuses. This is in addition to salary and stock compensation. This clip showing the exchange is where he released this figure where he talks about Meta's attempt to poach OpenAI's employees and where he gives this $100 million figure. Let's go ahead and listen to it.
They started making these like giant offers to, a lot of people on our team, like $100 million signing bonuses, more than that comp per year.
This is crazy.
And it is crazy. I'm really happy that at least so far, none of our best people have decided to take them up on that.
Right there, he says this $100 million signing bonus figure, which is crazy. That's not an overstatement. If you look at what the biggest NBA players are making, they'll sign like $20 million or maybe $100 million over a 4-year thing, right? This is more than most NBA players are making, far more. It's more than some of the top athletes are making. And in my opinion, this should be the case. I know that might be a little bit of a contrarian take here. It seems absurd to be paid this much, but we have sports figures playing basketball that make this much money. They have that much demand. Now, they got there because they're really tall, most of them, and they have skills beyond that, but being tall is a big part of being a professional basketball player. You can't really do it if you're short. In this case, the people that are creating this technology that's revolutionizing the entire world, changing everything we do in every way, making it so we have efficiencies, so we have luxuries we would have never had before. These are genius level engineers that are now being offered sports-like contracts. And that's something that I think it's finally time that should happen. I think that the people that are changing the technology of the world, especially the top tier, the most elite of the most elite in this category that got there by their own merit, not just by being born really tall, but they got there because they're geniuses. I think it's time that they should get a huge paycheck. We should see $100 million signing bonuses for people if they're truly worth it. So I don't have any problem with that. I think it's great for these employees to potentially get that. It's really interesting to see the dynamic here. But it also shows how much Mark Zuckerberg wants to be the leader in the AI race, that he's willing to pay quite literally anything to get there. This will be something I'll hit on in just a minute, but Mark Zuckerberg is wanting to brute force his way into victory with the AI war.
I think that people sort of look at the two paths and say, all right, OpenAI's got a really good shot, a much better shot at actually delivering on superintelligence, and also may eventually be the more valuable company. But I think the strategy of a ton of upfront guaranteed.
He says directly, knowing Mark Zuckerberg's going to be watching this, that he has a better chance of delivering on superintelligence, and he's going to be worth more. He's going to have the bigger company down the road.
Comp, and that being the reason you tell someone to join, like really the degree to which they're focusing on that and not the work and not the mission. I don't think that's going to set up a great culture. And, I hope that we can be the best place in the world to do this kind of research. I think we built a really special culture for it. And I think that we're set up such that if we succeed at that, and a lot of people on our research team believe we will, or we have a good chance at it, then everybody will do great financially. And I think it's incentive aligned with like mission first and then economic rewards and everything else flowing from that. So I think that's.
So he also criticizes the economic approach that Mark Zuckerberg's taking, and he contrasts that with OpenAI, stating that basically what Zuckerberg's trying to do is brute force his way into AI victory, just like he's done previously by buying applications. He buys them small, scales them up, doesn't create them himself, but rather just purchases his way to victory. With Sam Altman here, he's saying that they're building something organically, that the money that all his team will make, especially his top talent, it's not going to be the $100 million up front, but it will be owning a business that will be so massive, have so much growth, that they in turn will become super wealthy as this goal is accomplished long term. It's a much more aspirational way at looking at employing these people and compensating them. So he's attacking Meta at a lot of angles here, and I think there's some truth to it. Sam's also positioning himself as being one of these leaders that has a lot of loyalty. His employees want to stick with Sam Altman. And this is something where he has some ground to stand on. When there was the whole debacle of Sam Altman being ousted from OpenAI by the board, there's a letter that went around to all the OpenAI employees, like 750 total employees, and 720 of them signed saying that if Sam Altman went to Microsoft, they would follow. Basically saying that if the board really follows through with this, there's going to be a total exodus of employees. Our loyalty is to Sam, not the board. That's how much loyalty he had amongst the employees early on in OpenAI, and he's become even more of this figure leader that people are really bought into the vision, especially the top talent. They don't want just a fat paycheck. They want to get rich and accomplish the vision. They want to be part of something greater than themselves. So he's doing a lot of attacks here. I think that these are effective. He does have a point. Meta's in a position where they're coming from behind on this AI challenge, trying to buy their way to victory. I agree with most of what Sam Altman says here, but I still wouldn't count out Meta. Buying their way to victory has worked out really well so far. Meta has a superpower of scaling up applications extremely fast when they do have the right technology, and I believe Meta will be successful as well. That's going to be it for this episode. Hope you enjoyed. See you in the next one.